Now to an exclusive interview simulcast on Bloomberg Television and radio. So we welcome our radio listeners here this morning. We are talking about rising trade frictions as U.S. allies hit back at the Trump tariffs on steel and aluminum. Joining us from Tokyo is St. Louis Fed President James Bullard. Bloomberg Global Economics and Policy Editor Kathleen Hayes is also with us from New York. Mr. Bullard, thanks so much for joining us. Certainly a very timely discussion here in light of what we're seeing in Italy, these tit-for-tat tariffs that we are seeing between U.S. and its allies. Tell us a little bit more about what kind of discussions you might be having in the next 2 weeks in the next Fed meeting with your colleagues. How disruptive can this be for the economy?
The trade talk is increasing uncertainty in the economy, and when I talk to people in my district back in the Midwest or people over here in the Far East, everyone's talking about how the trade talks might change world trade arrangements. However, I think the proof's in the pudding. It really comes down to what is actually agreed upon as far as trade arrangements, and I'm not sure in the end that all that much is going to change.
Well, Jim, what about the political crisis in Italy, which had such an outsized impact on markets this week? I'm just going to be pulling up a Bloomberg chart from our library to show how this yield spread, Italy's 10-year bond over Germany's benchmark, it just exploded. So how does it affect your view of the proper course of Fed policy? Does it make a difference?
Well, I think uncertainty about the future of the euro has certainly been a big issue in the last decade, and the rise of Eurosceptic parties in Italy is a serious matter. So we'll certainly take that on board and discuss it. We've certainly been through this before with the sovereign debt crisis that raged in 2011 and 2012 in Europe. So it's a major factor, but I would also say that, when we've been projecting out what the Fed would do, I always felt that it was priced for perfection, as if nothing could ever happen or nothing could ever go wrong. And I think the Italian situation shows you that uncertainty can certainly rear its head at any moment.
Is it market volatility that bothers you, Jim? Is that the point for the Fed, that it has to be aware of, particularly as you raise the point? Seems to me you're saying at a time like this, maybe you just sit back and do nothing.
Well, there is an aspect that benefits the United States. It tends to drive longer-term yields in the U.S. lower, and we've certainly seen that with the U.S. 10-year now trading at 286 this morning here in Tokyo. You can benefit in the U.S. from the fact that our European brothers and sisters are having their own troubles, but I'm not sure that's the way you want to run an economy. You want everything to be smoother than that.
Hopefully. Jim, looking at what's happening in Italy, as well as what's happening with all the trade tensions, not just with U.S.'s allies, but with China as well, to what degree do you think that this is more ammunition for yourself, being the strongest dove, on a slower rate hike, slower expectations?
Well, as you know, one of the things I've been concerned about is that we go ahead too aggressively and too much on a timetable and not sensitively enough to incoming data. And this is the type of thing that could give a person pause. I'm not saying that it will, but renewed crisis in the EU would certainly be a major factor from the U.S. point of view and how we want to proceed. I don't really think we're to that point yet. It sounds like the Italians have formed a government, and we'll have to see how this plays out over the summer here.
Jim, hold on a second here. We just have some breaking news coming through from Samsonite. We are now learning that the CEO, Ramesh Tanwala, has resigned. This, of course, has on the back of news here this week from the likes of short sellers like Blue Orca Capital, which alleged the accounting lapses surrounding the company as well as poor corporate governance. And Blue Orca as well has raised a lot of questions about Tanwala's resume, while others have actually offered some bullish opinions as well. But we are learning now that the CEO, Ramesh Ramesh Tenwala has resigned. They're appointing Kyle Francis Gendreau as the new CEO. So we'll continue to watch those lines coming through from the company. But Mr. Bullard, I want to bring it back to our conversation as well. In particular, when it came to inflation, I know you have a big concern given just how low inflation expectations have been. But what we've learned from the FOMC minutes here, that there's some doubt of whether 2% inflation can be sustained. If the economy is indeed doing so well, why do you think there seems to be a lack of consensus or uncertainty around that?
Yeah, the feedback from relatively rapid GDP growth and relatively strong labor markets into inflation is a factor that used to be important and used to be of empirical relevance, but now you look at it today and over the last decade or more, it really doesn't work that way anymore. And so I'm not sure that faster GDP growth by itself is going to indicate that inflation is going to move up any faster than it has in the past. So I'm not sure that we're really there yet. If you look at Dallas Fed trim mean inflation year over year, it's about 1.8%. Sounds like core PCE about 1.8%. And so we've been doing a lot of normalization even before inflation really even got back to target, much less got above target and got into a situation where we had to tamp down on inflation. So I really think that we're in a pretty good position right now where we are with the policy rate and where we are with the normalization policy, and we could play it by ear and see how the data come in from here.
Jim, you know, I know you'd probably prefer to see no rate hikes, but it's pretty clear that your colleagues on the FOMC are signaling that June hike. It looks like a slam dunk. Meanwhile, the markets have sort of priced out a third rate hike. So is it possible at this coming meeting for the Federal Reserve to communicate, okay, we're hiking the rate now because of growth and inflation's at target, and yet also indicate that uncertainty over Italy, trade, et cetera, means that a third rate hike is not definitely on the table and has probably been reconsidered?
Well, I'd cite the former chairman, Alan Greenspan, as saying, I think we're on the record as being vague about that. And I think that's pretty much where we are as a committee right now, as if you look at what different members have said publicly, you know, they've hedged their bets about how the committee is going to behave in the future. And that is certainly totally appropriate. I think we should be dependent on the data. We should be taking on board developments in the U.S. economy and the global economy, and then discussing that at the various meetings and deciding what to do. So I wouldn't want to prejudge how we're going to play this either at the June meeting or through the rest of the year.
Jim, Lael Brainerd, one of your colleagues of the past few years, someone you know well, gave a speech today in New York, and she said the Fed is going to do gradual rate hikes from accommodative policy to neutral policy to something modestly above neutral. Is there a risk in that? Is that what the Fed is going to do? And is it the correct path if, in fact, that's what happens?
Yeah, I've been arguing that we're already at neutral today, and if we keep going up from here, we're going to turn restrictive, possibly in a situation where inflation hasn't made it all the way back to target yet. And if you look at the TIPS-based expected inflation and make an adjustment to get it translated into PCE inflation, the markets are really saying that they don't see enough inflationary pressure to get PCE inflation back to 2%, even over a period as long as 5 years or even in the 5 years after that. So I think inflation expectations are still a little bit weak here for us to be moving into a restrictive mode. And what we should do is stay where we are and let inflation expectations recenter on our 2% inflation target. That'll set us up much better for prolonging the expansion from where it is today.
Jim, you and your peers have your own versions of a neutral rate. What makes yours the right neutral rate?
Well, it's just one analysis out of many, and I understand that, but I really think that the global safe short-term real interest rate, if you look at the data and you look at what's been said about it, it is still negative today. And if you add 2% to that, you get a long-run neutral federal funds rate that it's below 2%. And that's about where we are today on the federal funds rate. So that's one argument for saying that we're at neutral or close to neutral right now, and we don't really have to do very much going forward. People come in with Phillips curve arguments saying, well, unemployment's low and that means inflation's going to go up in the future, but the Phillips curve correlation is broken down, and it really doesn't look like that's going to be a factor, or not much of a factor, over the next 2 years, let's say. So I think we're in great shape today, but I think we could stay where we are and let the data tell us what to do next.
All right. As you say, we could stay where we are, but if you could paint a scenario, paint a picture to outline when you would say that you're not a dove and you say, all right, let's go ahead and hike. Paint that picture there in terms of GDP, wage growth, employment, inflation.
Yeah, I think for that to happen, I think inflation would have to surprise to the upside, and it certainly can do that, and maybe that will happen. And in that case, I would relent and say that we should definitely move to try to contain that. But I don't really think this is a situation where the Fed is behind the curve. The Fed is ahead of the curve here. We've already normalized quite a bit. We've initialized a balance sheet decline. In a world where the ECB and the BOJ are still expanding their balance sheets, we've moved off the zero bound in a world where you have negative policy rates around the world. And so we've done a lot already, and we did all of that in a situation where inflation was still below target, not above target. So I really think we've been preemptive already, and that's what's containing inflationary pressures in the U.S. For now, and so I think we could play on that, stay where we are, recenter inflation expectations on 2%, and set ourselves up for the future in a better way.
And Jim, I know you raised some concerns about that yield curve flattening as well. I mean, why do you think that is such a meaningful indicator of a recession for you? I mean, this sparked quite a lively debate, it seems like, from within the FOMC. Especially, it's been right in the past, but when you have heavy issuance on the front end and the impact of QE on the back end, doesn't that create distortions?
Yeah, it's probably not a perfect indicator, but boy, if you look at the post-war record of yield curve inversions predicting recessions in the U.S., it's about 100%. There's really only one false signal in that whole time period, and it was in the mid-60s, and even there was a significant slowdown when the yield curve inverted. So I think we have to take it seriously as an indicator of what the market thinks versus what the Fed thinks. One way to think about it is that the Fed is very influential at the short end of the yield curve, but a lot less influential at the long end. And when the yield curve is inverted, it indicates that the Fed is too optimistic relative to market-based expectations, and that's what leads to the recession. So I think we do not need to push so hard that we get into a situation where the yield curve is inverted. We just don't have to do that in this situation. Inflation is only running at 1.8% right now, so we haven't even gotten to target yet. If inflation was running at 3%, I might be singing a different tune here, but we're not. And so I think we can just, like I say, stay where we are. If we keep ratcheting up on a sort of calendar basis, the short end of the yield curve, we may get an inverted yield curve either later in 2018 or early 2019. And we've seen this week how volatile the long end can be when there are events in the world economy that occur. I think the 10-year yield might have fallen 15 basis points on the day on Tuesday, if I'm not mistaken. So this can move around quite a bit. We don't have that much of a cushion to prevent yield curve inversion. So I am concerned about this, and I want to have that debate now, not when we're already inverted. I'll just say one other thing about this. As a staff member in 2000, 2001, and again in 2006, 2007, we had inverted yield curves in those periods of time. And the talk around the Fed among the staff was that, oh, don't worry, this time is different. This doesn't indicate that there's a recession ahead. And both times we got burned, and we did get a big recession. So I've come around to respect this signal from the market. And I think we're in a situation where we don't have to test this a third time.
Okay, well, obviously you and Lael Brainerd are going to have to discuss that at the next meeting, Jim, because, she thinks it's not such a good indicator of recession. But jobs report, just have to ask you, and following on Ramey's point, I think, unemployment at 3.9%. The Beige Book and companies talking about having to raise wages, particularly for the lower end, because they can't find enough workers. Jobs growth is staying at a nice, healthy pace. Doesn't that suggest an economy that's strong enough to do the path of gradual rate hikes, at least 2 more this year, just to stay on a path where you avoid any kind of overheating or any surge in inflation?
Yeah, I mean, we've got a well-functioning labor market, so why mess that up? Let it function and let these people find jobs. We've got African American unemployment and Hispanic unemployment coming down to very low levels. That's certainly good news. We've got people coming in off the sidelines. You'd like to get them settled into good job situations that they can sustain going forward. So I just don't think that we've got any call here for disrupting the labor market from where it is today in order to do something about inflation. Inflation's still below target even now, and I just don't think we need to go in that direction. It's sort of an older idea about how to run monetary policy. I think we have a lot of credibility that we will take action if we need to keep inflation under control, and we have done that. We've been on the low side of our inflation target for 6 years now. So, sure, things are going well in the U.S. That's good news. I don't think it means that we're going to miss our inflation target by any appreciable margin.